Summary of the open market committee meeting yesterday is we did see a 25 basis point or 0.25% cut in Fed funds rate. This takes the range down to 4 to 4.25%. This is as expected. Also noted in the notes to the meeting were that there are 2 more cuts expected this year, with 1 more cut in 2026 and 1 more in 2027. Now, of course, that can change as the data changes, but that's what is expected based on what was released yesterday. The drivers of the decision this month, and it appears in the coming months, is that employment concerns and the downward trend of employment is taking precedence over inflationary concerns. Among the members of the FOMC meeting, also, it was noted that there was an unusually wide dispersion of expectations based on the economic data looking forward. This has to do with the GDP, employment, inflation, etc. Let's take a look at this chart, which we discussed on past presentations covering the Fed. This chart is provided by McClellan Financial Publications, and it shows in green the 2-year Treasury note yield, and this is determined by the marketplace as a whole, not by the Fed. It's not a stated interest rate by anybody. It's what the market determines the interest rate should be. And in black, indeed, is the federal funds rate. Now, this is before the cut yesterday. And you can see on the right-hand side of the screen over here, there was a very wide gap between what the market is expecting interest rates to be versus where the Fed had interest rates. Now, you can see that even with the 1/4 point drop in rates yesterday, there's still quite a gap here. The market is still expecting those 2 cuts coming later this year. Now, let's take a look at our next chart. We have seen this before also. This is the yield curve just before the Fed announced yesterday. And you can see that in black is the yield curve from 1 year ago. In blue is the current yield curve as of about noon yesterday, which was the day of the FOMC meeting. The green line is the usual difference in yield between 1-month Treasury bills and 30-year Treasury bonds. This is 1-month Treasury bills on the left. And if we add 2% to that, we would get 5% yield on the 30-year bond. Now, that's a normal yield curve that we should see. And so yesterday, the Fed dropped interest rates by 1/4 point, and we are expecting to see in years to come the Fed to lower interest rates down to a base of 3 to 3.25, which is considered the neutral rate by the Fed. Now, what I've noted here in yellow at the 5-year mark, this is the interest rate that drives a lot of consumer loans, especially in the auto industry. And you can see that these are actually low. They've already anticipated a great deal of what's to come in terms of the decline in interest rates by the Fed. And in yellow to the right of that, on the 10-year Treasury, is the 10-year Treasury, which is closely associated with what the market deems appropriate for mortgages. So as this yield goes up and down, so does the yield on mortgages. And you can see that this is also anticipated much of the discount or the decline in the short-term end of the yield curve where the Fed dictates the rate. In other words, don't expect to see a lot of drop in yields on these further out maturities, even though the Fed is going to drop the yield on short-term maturities quite a bit. Now, let's take a look at what this means for investors as a whole. Number one, a decline of about 1.25%, and that 1.25% is from before yesterday's cut. So another 1% cut from here in interest rates on money market funds and savings rates over the next 18 to 24 months, a slow growing GDP with the risk of future negative surprises in growth. We're expecting to see inflation adjusted GDP for years to come, at least based on the Fed's analysis, of less than 2%, which is low by US standards. Only slightly lower bond and auto and mortgage rates should be expected since they've already anticipated much of the cuts to come. Also, a tightening of lending standards by banks and private credit firms due to the slowing economy, which is driving increasing loan and credit card delinquencies. You can send us an email at info@trademarkcapital.com. You can also follow us on X, YouTube, and LinkedIn. If you have any suggestions for future videos such as this, please send them our way, and we'll try to get a video out, short but to the point, on your request. Thank you for joining us today.